Harnessing Your Wealth isn't your average money podcast, hosted by Billy Peterson, a former jockey turned financial advisor. It's about more than dollars and cents. Each episode dives into the stories, struggles, and successes that define what real wealth looks like. From bold entrepreneurs to everyday dreamers who've learned that true success isn't just earned, it's lived. Because life, like wealth, it's all about how you ride it.
Hey gang, it's Billy and Shaun. Harnessing Your Wealth, year-end 2025. This is an important discussion because who doesn't want to find ways to save money, protect the assets that they have, and try to be smart about things, especially in the time of year where everybody's spending money as fast as they can. So we're going to talk about several strategies that I think are going to help everybody. Take one or two of these, mark them down, write them down, and try to implement these before year end. That's why we're talking about this today. Number one, we're going to talk about some tax moves before December 31st. I think importantly, you want to try to max out your 401k plans if possible. So check where you're at right now with regards to what you've deferred and what you can actually put into your 401k plan, and see if possible, get that up to that max level. Make sure that you're at least meeting the employer match level. So your employer is matching you up to a certain percentage, like maybe up to 3% or 4%. Make sure you're at least deferring that. And if you haven't yet, increase your contributions before year end. You can just contact HR, ratchet up your next paycheck before year end, or defer some more money before the time runs out. Don't leave money on the table like that for that match. That's free money. If you're self-employed, consider that SEP IRA or a solo 401k. Pay yourself and get some money plugged away into these plans so you can beef up your own retirement, but also to capitalize on these tax deductions that are available to you. Also, consider tax loss harvesting. This is a kind of a new word to some people that have never heard that before. So think of yourself as a farmer. You're harvesting what you grow. In this case, you're harvesting losses. Now, when you're an investor, you're really not looking to lose money, but occasionally you're going to have some things in your portfolio that have declined in value temporarily. So they, especially if you're in an account that has individual securities like stocks or bonds, you may be able to go through, handpick some of those individual stocks that might be down at the present time and sell those, book the loss, take that loss and apply it to any gains that you may have already incurred. So that's called harvesting your losses in order to offset some of the gains that you may otherwise be paying capital gains tax on. Now, your capital gains tax is going to depend on your income level. It's either 0, 15, or 20%, depending on your income. I won't go into that today, but just know that you can find that information or call us if you want us to go help you out and understanding a little bit more about your capital gain situation.
And if you're out there, this is not a strategy for like a qualified, like a 401k or IRA type of account, because those are tax deferred. Billy's referring to your taxable accounts when doing
taxable.
That. So don't go in and sell your 401ks.
No, don't do that.
That makes zero sense.
And speaking of the taxable accounts, be careful that you're watching out for the wash sale rule. And that refers to the time period that you need to withhold from buying that security back. It's 30 days. Basically, it ends up being 31 days between the time you sell to book that loss and the time you can purchase that security again. And, a lot of people want to own those securities, especially when they're down. It might mean they're great values at the present time. So that is the one small risk associated with tax loss harvesting, is you're going to be out of that security for that 30-day period before you can buy it back and still use that loss on your tax return. A couple more real quick on the tax moves. Charitable strategies. Make sure you're thinking about donating to certain favorable charities, or establish a donor advised fund. That's a kind of almost like a family foundation you can use for your own family, and set up and contribute even up to large sums of money in a single year. It never actually went through to any charities yet until you've made those determinations, but you did receive the large lump sum tax deduction in the year you donated to your fund, so to speak. That fund can be set up at any firm. We can help you set it up. We set donor advised funds for many clients, and the money can be invested according to your profile of how you want that money to grow, and then can be distributed to certain charities over time at your choosing. You can also use what's called a qualified charitable distribution if you're in that situation where you have a RMD coming up. And you don't really need the RMD, which is a required minimum distribution from your IRA. You can actually elect to have the RMD money paid directly to a charity. And if that's the case, you have no tax consequences whatsoever.
It's very smart strategy for those that are already, say, tithing or supporting some charities. You're having to take money out of this IRA. The IRS is forcing it out because they want to tax you on it. Well, one way to get around that is just have it go directly to a charity. And you got to be careful in the way that you do it, that it doesn't come to you, then the charity, it's got to go right to it. So we're very good at helping people with those.
Right.
What
Normally,
else?
the RMD, they want you to take a withholding and send it to the federal and the state. But if you elect that qualified charitable distribution beforehand, it will work. Now, you can't move the money to a donor advised fund.
You cannot. They're talking about changing that.
Right.
But right now, you cannot move it to a donor advised fund. So it actually does go straight to the.
You have to have a
501c3.
charity selected.
You do. I mean, common one in Utah is the church.
Mhm.
A lot of people do that with their tithing.
Yeah. Last thing, a couple more in this tax moves. HSA. So if you have an HSA, make sure you get that funded before the end of the year, before tax filing deadline.
You have till April, but it's still good. I mean, what we see sometimes is people just wait till the very last day and then they go, I want to do this right now.
Yeah.
And it's like, great, we'll get it done for you. But we could do this months in advance and prepare. And if you're going to do it, that'd be a great time. And I also add on those HSAs, try to select one that allows you to actually invest the money.
Mm-hmm.
Okay.
Right.
Because, and I'm kind of an advocate of pay for your healthcare expenses out of your own pocket right now, if you can. Let that HSA grow over time. And now you've got a tax-free account in your retirement that can handle all or some of your medical expenses.
Let's hope that we don't have a lot of medical expenses, but hey, some people will.
Medical expenses. That could be, massage therapy or, mental health person, whatever it is. So
you're going to need some of that for sure.
Yeah.
The contribution limits for this year, $4,300 if you're single and $8,550 for a family. And that's nice because it's fully deductible from your income. Yep. So think about that. Triple tax advantage. And then you can use it for those medical expenses as they come forward. The last thing I say is kind of your withholding amounts. And so, especially with this new tax bill that was passed this year, you all know it. It's the big, beautiful bill. Now, many people are going to qualify for some additional tax deductions or reductions in their tax bill. So if that's the case, you may want to think about talking to your CPA about your future withholding amount and what's going to make sense. Some people get this idea that having a refund check every year is a really, really wonderful thing. It's not. Statistically, only about 60% of people just spend their refund check. Only 40% will actually invest or save that refund money. Now think about that. It's like money that you didn't know you had, but it's all of a sudden given to you. So you just think, no, we're going on vacation or let's spend it on clothes or, something that's just going to lose value immediately versus if you just kept that money in your own account all along. Remember, you gave the IRS free loan on that money. You gave them the free loan for 1 year. They paid you no interest. You got nothing in return and they held it for you and they took advantage of that. Now, on the alternative side, Shaun, do you know what the IRS charges you if you are late in making a payment to them?
I don't want to know.
Well, there's a couple problems with that. They charge you 7% interest and a penalty, which is added up every month. So it's 0.5% monthly for every month you're late on that. So think about some people are 2, 5,
it's like
10 years late.
Mafia, man. That's like Tony Soprano type of
They
dude.
have a license to steal. They come at you. And they don't even need a gun. They just come get you. They take it. So I think that people need to be aware of the fact if you're getting a refund, it's not such a smart thing to do. Adjust your W-4 if you work for a company. If you are a self-employed person, then it's a W-9 as far as how much it's going to withhold. You want to make sure you're making those adjustments and looking at that right now.
Those are good tips. I like that. Yeah, you mentioned we're in holiday Christmas season. I mean, you're getting inundated with emails with deals, and you're thinking about all these gifts you're going to do. And we find, and we've seen people that tend to overspend during this time. So we go back to the tried and true, hey, let's get a budget together. And it doesn't have to be a full year budget. People hate the word budget, but maybe like a holiday budget where you're just kind of categorizing things of, we look at like a bucket strategy. Mm-hmm. So we've got your gift budget, we've got your travel budget, and we've got like the events and food, because everyone loves to eat, drink, and be merry through these holidays. And it would be wise, and I think would make you be more conscientious of what you're doing during this time if you had cash for these buckets. Mm-hmm. I know people, probably young people, are going, who are these dinosaurs talking about cash? But guess what? It works. So that's one strategy or technique that we found is helpful, is just divide things into bucket categories, set some cash aside, and now you're good for the year.
At a minimum, know that you have money, cash in the bank to back these expenses up.
There you go. That's great too.
Because too many people just go spend and put it on the card and then deal with it later.
It's insane. And we see it all the time. And we really like even a debit card, because you're just spending the money that you have. And we advocate this in our financial boot camp, telling kids, hey, stay away from credit cards, use your debit card, because you're just swiping it and you're not really sure how much you're spending. And all of a sudden you get that January statement. You're going, oh God, or December statement you're going to get in January.
Yeah.
I mentioned this, but you look at your phone and you're probably getting the same promo emails that I'm getting about, hey, this is 40% off or Black Friday sale. Don't miss it. And I sit back and ask, did I even want it? And so now just because it's 40% off, I'm going to buy it and I don't even need it.
That's FOMO.
FOMO, fear of missing out. So try to unsubscribe from those. Make a gift list beforehand, kind of plan out your holiday spending, and then you're less inclined to have impulsive buys. And then just set boundaries, set some non-negotiables. We hear a term called the January hangover, right? Everybody was partying, having fun in November, December, spending all this money, and then they wake up to that January hangover when they realize they owe a lot of money. So just be cautious. And we're not trying to be Grinches here. We want you to have fun. We want you to enjoy your money, but we're just trying to give you some basic tips.
And help your kids do these same types of things for their expenses and their spending on gifts for the holidays. Because sometimes kids don't understand that there is a limit. And especially this time of year, it's really smart to have that money earned and put away and not just go all the way through it. Let's go into some other tips that have to do with your personal cash flow situation. And that's to audit. We call your top 5 expenses. So look through your monthly statement, what can be your credit card or other things that you're paying for in your personal life, and see if all those expenses under those categories still make sense for you. That could be things like subscriptions. You subscribe to certain things. Make sure that that's still something that's necessary. Your insurance plans, and your utilities, dining out expense. That's a big one for people these days. And then groceries, obviously those costs, a lot of times we don't have any control over that because just the inflationary impact of the cost of groceries is it's getting more and more difficult. But take a look at those things and just see if there's any way to cut back on some of those unnecessary items.
Can I share one with you?
Yeah.
I was looking over our end of year bills, and it kind of categorizes things similar to this. And one was really big, and it was utilities. I was like, what the hell is going on? So I go back and I start looking. 3 months in a row, my water bill was over $500.
Wow.
And I'm like, what is going on? I had a leak, a slow leak. So, I mean, I hammered myself, but at least I caught it. I'm going to save that money going forward and fix the leak. So it's good to look at stuff like this because it just goes unnoticed.
Sometimes you never do realize that. And I probably have a leak myself. I'm starting to think about my water bill. Update your emergency fund. So we always advocate for 3 to 6 months of your living expenses, make sure you have that amount in what's called an emergency fund. It's kind of hands off. It's sitting in bank. It's earning maybe a short-term money market rate or just a savings rate, but it's money that you have available. And if you don't have that amount right now, think about your year-end bonus if you're going to get one to try to help top that off. Don't just think about that bonus as being money to spend. Too many people get in this habit of in, out, in, out. And you have to start thinking about saving and putting money away. And then think about for next year, automating things that can be automated. And that includes sometimes bill pays, so things that you can avoid having to receive a bill. It's just going to pay for you if it's just a standard thing that you know is going to occur. Or if it's, for example, putting money into a mutual fund or to your 401k or to your IRA, automate that. Set that up to it happens without you even thinking about it.
Love it. Let's get into some retirement, some investment planning, things that you can do. Roth conversions is a big buzzword right now. Particularly when you have a low income year, maybe you have a little room in your tax bracket where you can convert some IRA dollars, so some pre-tax dollars to some after-tax and tax-free dollars. So it's pretty simple to do. What we typically advise is, when you're converting that IRA amount, it's a taxable event. Mm-hmm. Make sure it makes more sense to us that you have that tax money set aside in a separate account. So you're converting the full amount, pay your taxes with your money over here in the different bucket. What this does is it avoids that 10% early withdrawal penalty from a traditional IRA, and it can allow people to get more money into a Roth IRA, which we think is one of the most powerful accounts, especially for you younger people out there. Looking at another strategy called the backdoor Roth strategy. So this is for high income earners who are over the threshold of where they can do Roth contributions. They can do a non-deductible contribution into an IRA and then convert that over to a Roth IRA. So a powerful strategy for those of you that make too much money and can't do Roth. Now, this happens a lot. A Roth IRA has income limits. A Roth 401k does not. Mm-hmm. So if you're eligible at work for a Roth 401k, ignore what I just said. That's a different type of an account. The other thing we want to look at is just reviewing your holdings, whether they're in a 401k. We're doing this for our clients right now and just looking, is it necessary to rebalance? And we don't believe in like rebalancing every single month or even sometimes every year. Sometimes you need to let your winners run and just make sure they're staying within the percentage or the risk tolerance that you're okay with. But just looking at your allocation, seeing if there's any adjustments that you need to make. If you're unsure, I know a couple guys or a few guys here that could help you out with that. And then one other thing you kind of mentioned about automating things. This kind of goes with this rebalance. Automate so your 401k contributions go up 1% or 2% every year. Right. If you're not already maxing out. And most 401k providers will allow for that to automatically happen.
So it increases with, for example, your salary increase.
Yeah. Mm-hmm. Increase it every chance that you can. And then before you know it, you're maxing out. The last thing on this retirement and investment and planning is take a look at your beneficiaries. Has anything changed? Have you been divorced? Has a spouse unfortunately passed away? Do you need to update who would receive your money if something happened to you?
We just dealing with this right now with a 401k plan employee who passed away, had not updated his beneficiary form.
And had got divorced before he passed away.
Right.
Unfortunately. And now the ex is...
it's a nightmare.
Yeah.
You can imagine, existing, former spouse, now new spouse potentially, or
kids are involved.
Girlfriend, kids. Just failure to look at things and continue to make these adjustments. Things happen in your life. Let's face it. You might have a divorce. You might have a marriage. You might have a child. Let's make sure that you're updating your documents to go along with the changes in your life.
100%.
The next is insurance and risk. Okay, so everyone has to deal with this. I know a topic no one wants to talk about because no one likes to talk about insurance and risk. It's boring. But we all have these things to prepare for and plan for. look at your life insurance policies. And if you don't have any, you might want to consider picking something up for yourself, for your beneficiaries, especially if you have a young family and you have a lot of debt. It's important that you don't leave your young family strapped with a whole bunch of debts if you passed away, unfortunately, and an unforeseen situation happens. But think about new dependents that are relying on you. Think about your debt levels. Again, if you have a mortgage, you can pick up some or cheap term policies.
One spouse having to replace the income of the lost spouse. That's
we see too many things in our line of work with people that are not only dealing with the tragedy of losing a spouse, but now the tragedy of how are they going to pay for everything that they've once were being helped with another income source. And now they don't have that income source. And now they have to sell their home or sell all their assets that they've been accumulating. Look at your home and auto policies to make sure that those rates are still consistent. You can always benchmark that with another carrier. If you have a claim, it's funny. Your insurance company, you may love them, but a lot of times they don't love you back, and they're ready to dump you as soon as you file for your first claim. You find that out the hard way. So don't fall in love with them. Look around and see if there's another carrier that could provide as good a service and better rate. And then healthcare, if you've already met your deductible and you need some kind of medical or dental work, I'd strongly recommend getting that done before the end of the year because you've already hit that deductible and you're not going to have to pay any more out of pocket for that. So once you've hit it, get the rest of the work done.
Some tips for you business owners out there. So if you haven't heard about it, you should have heard about it. Section 179. So this is allowing you to depreciate some assets or purchases that you've had for your business. And there's also a bonus depreciation added to this, I believe, with the latest tax bill.
Yeah, they've really ramped that up for this latest bill.
Yeah. So the normal one is you depreciate it over a certain amount of years, depending on the equipment sometimes. But the bonus one is take it all in 1 year. You get all that depreciation captured in 1 year, which can save a ton in taxes. And for you S Corp owners, you want to make sure that your salary that you paid yourself throughout the year is reasonable, because the IRS, that's one thing they want to look at. I added in here also looking at setting up a solo 401k or a SEP, like Billy mentioned earlier. Very easy account types to set up. Solo 401ks, you're getting close to the deadline. You want to get that going as soon as possible. And then maybe just looking at your QuickBooks, sitting down, hey, did I have high expenses in a certain area? Do I have any receivables that I'm trying to collect by the end of the year? Just getting that all buttoned up so you've got, maximizing your income, obviously, and also your tax benefits as a business owner. Flowing into this here, just kind of talking about estate and legacy planning. Once a year is probably overkill, but where we're at the end of the year, sometimes it's nice just to take a quick look. Have I looked at my will in a while? How's my trust looking? Who are my powers of attorney if something were to happen to me? Has my family dynamic changed? I mean, you're going to see all these people over dinner, and maybe you want to disinherit one of the kids.
All the time.
Cade. No, just kidding. But it's a good time to look at those. The annual gifting exclusion is also still out there. So for those of you that would like to gift money to your kids, we're doing quite a few of these right now. I like, and I know Billy prefers this too, is gifting highly appreciated stock.
Yeah.
You avoid any capital gain tax exposure. You can give it to your children and they can decide if they would like to sell it, pay the tax, or if they would like to just keep that holding and let it continue to appreciate for them over time.
They'll typically be at a lower tax bracket than the one making the gift. And currently those annual gifts are at $19,000. So you can hand them a $19,000 check, sure, and they're mostly going to, cash the check and spend it. Or you can have us come up with the $19,000 worth of stock that's typically highly appreciated. So ultimately, what did it cost you? It cost you only that prorated amount of what the original shares cost. You may have only put $5,000 into that stock, for example, maybe Apple or Amazon, and it's now worth $19,000.
Right. And you can do a split gift. So if you're married, you can give 38 because each person can give 19. You can get more than that, but the 19 is that you don't have to file a gift tax return. Right. So, somebody
can add up a lot if you have a big family, with spouses and grandchildren, and you can give 19,000 to anybody. Yeah. And for those with the large estates, it's a pretty good idea to do that.
Yeah, and just think about you're removing that future growth from your estate, which could, compound a tax problem down the road. Account titling, it's very important to just look at, hey, did I tell Billy and Shaun and the team I created a trust? Do I still have a joint account with them, or is it a trust account like it should be?
Right.
Or is your house titled the correct way? Properties that you have out there, are they titled in your trust? And very easy to overlook that.
Make sure everything's tied into your overall plan. Talk to your advisors about that going into the end of the year. I really strongly suggest talking to your financial advisors or whoever has your investment accounts, if it's a taxable account, about any tax loss harvesting, about the account titling, and about any types of contributions you could make to ramp up your deductible IRA or retirement plan contributions for your tax benefits. And then kind of going into the last section here is your goals for 2026. So let's evaluate where you're heading. And we talk about simplifying your goals. So make sure you choose just a few targets for 2026 of what you're really looking to do and make those stick, right? What is it that you want to do this year? What's the most important thing? Think about financial, think about personal, and tie those together. What you want to do, what do you want to accomplish? Are you going to try to get another certification or credential or get that raise or get that promotion? How are you going to go about doing that? Are you going to reduce a debt? Are you going to try to pay off the vehicle? What's the plan to get that accomplished? Make sure you kind of map that out and use some professionals to help you.
I would like to shave 3 strokes off my handicap.
Okay, Shaun, I don't know how to help you there. What I'd say is you can't golf any more than you already golf. So I think you're probably screwed.
Once a week is not enough.
Right. Plan your major expenses now. So what we're saying, if you're going to take a vacation, start talking to your spouse if you're married, or think about what you want to do personally. If you're going to take a vacation, what does that budget look like? What kind of vacation are you going to take? We build these financial plans for our clients where we pretty much know what is available, what kind of resources that they have to take the type of vacation that they want. So stay within that framework. Don't just come up with a location and then hope it's going to work out financially. Also, if you want to do a remodel or if you have some costs that are associated with, again, a purchase, something that's going to improve your lifestyle, then make sure that you're considering how that impacts your financial situation. Have you planned for it? Have you earmarked money for it? Is it set aside? You're going to have to draw on your portfolio. And if so, has that been considered in the grand scheme of things? Is it going to really hurt you from a standpoint of your probability of success with everything else?
I love it. All very good tips.
So those are some great points that Shaun and I felt like we wanted to share with you today on the show, and hope you guys can capitalize on a few of these things. We hope you enjoyed this. Share this with your other friends, colleagues, family members, children, whoever might benefit from this. Hope there's some good tips. I want to say thank you all for listening, and I know we're getting toward the end of the year. Thanks for being listeners of Harnessing Your Wealth. We try to provide some great resources for you, not only from the standpoint of our guests, but just tips and strategies that can help you on your path to harnessing your own wealth. Yeah. So until next time.
Have a Merry Christmas too.
And enjoy your Christmas. Merry Christmas, everybody.
Merry Christmas.
Thank you for listening. For more information about today's show, please check out the show notes. Visit our website at www.petersonws.com or give us a call at 801-475-4002. Peterson Wealth Services is a registered investment advisor. This is a paid-for advertisement. Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of a personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Peterson Wealth Services.